It's been pretty interesting to see how resilient gold in particular has been. It's still sitting above as we record this. I don't want to date it, but as we record this, gold is still holding that $5,000 level. Gold and silver having their moment. I mean, what a moment they've had over the last couple of months.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz, and special treat for you today. Someone who's been on the show a number of times over the years, uncannily been correct, and certainly has been a master strategist as far as the market's concerned. I'm talking about Jerry Robinson, followthemoney.com. Jerry, it's great to have you back on the show, and it's overdue. I mean, the recent movement of gold and silver has taken the so-called experts by surprise.
Indeed. Thank you, Kerry, for the invite to be here. I appreciate your work. Gold and silver having their moment. I mean, what a moment they've had over the last couple of months.
Yeah, so right now they're hitting some volatility, which is really to be expected, especially silver at $120. It literally went straight up parabolic. So there had to be a crash. Fortunately, if you're holding physical, you don't really care. If you're in the paper, then I'm in both, but out and out, I'm a physical bull. But gold's still like close to $5,500. Where does it all end?
Well, it's been pretty interesting to see how resilient gold in particular has been. It's still sitting above as we record this. I don't want to date it, but as we record this, gold is still holding that $5,000 level, even though it rallied up to 5,600, pulled back to. In fact, I have a chart. Maybe we should show this.
Let's go to the videotape.
Sounds great. Let me pull this up. Yeah, here we go. This is on our website, followthemoney.com/charts, where we can come down and look at some different charts. But let's go to the gold chart, and you'll see here what we're seeing. And hopefully that's big enough. Can you see that, Kerry? Is that
perfect?
Okay, good. Well, you can see here that we got all the way up at one point to about 5,600. I'm sure many of your listeners and viewers are familiar with that rally. That was just so incredibly breathless. The pullback, interestingly, brought us back to the rising 50-day moving average. And despite an intraday cross below it, it never closed below it. And so we actually on a daily basis. And so it's held. There was one moment when we came down and found support there again. And so that 50-day moving average really working out well for gold, holding on really well. And we're holding that $5,000. Now, the thing that has me concerned as far as the near term, not longer term, I'm like you. I think that we are just living in this constant state of debasement, currency debasement. I wrote about it in my book, Bankruptcy of Our Nation, which has been around for a long time. All of this stuff is in there talking about the debasement of fiat currency, the fractional reserve banking, the national debt, all of this stuff. Well, it's all weighing upon the dollar. And of course, gold and silver, but particularly gold, is a huge beneficiary of poor monetary policies. And this particular chart here kind of tells the story. You'll notice from a technical perspective, whenever you are watching a chart, this is a weekly chart, and again, maybe a little difficult to see there, but you'll see that there are some long upper wicks that develop on these candlesticks. And the longer that upper wick is, the more prohibitive that area can be from a technical standpoint as far as overcoming it. So, for example, we hit this peak. Let me zoom in just a bit more there. We hit that peak right there at about 3,500 back in early 2025. And you'll notice that we didn't actually get back above it for several months. Something similar here back in early 24. We had this long wick, and then it took us a while, several months to get past it. Go back to 2022. We had a long upper wick there, and it took us, practically a year and a half, maybe even more, to get past it. So this is the longest weekly upper wick that we have on the chart, on this chart going back, for the last 5 or 6 years. And so this one's really long. This one is just going, not that we can't just overcome it quickly, but typically it takes some time. So from a technical perspective, my view is that we do have more time to accumulate if that's what your goal is. Now, whether this is like a 2011 rally and then kind of blow off top and then we don't get back there for 15 years, I'm not of that opinion, because we are are we still in year one? No, we're in year 2 of the Trump presidency, right? This is the year 2.
Yeah.
So
second year, January 20th.
There you go. So we just entered year 2. And so we have, a few more years. Going into the second Trump term, my thesis was that he's like the best president for gold. I mean, can you find a better president for gold? I don't think you can find one. No one really drives up gold and go back to the first term when Trump was in office. It was great for gold. So the point being is that because Trump is going to be in office for 3 more years, and I can't imagine the chaos levels going down at all. I can't even imagine what that would look like. This is there's a premium built in for Trump. Now, part of the reason we saw it pull back so much, Kerry, was it came on the announcement, and there's arguments about this. It's arguable whether this is the actual reason it came down, but there was a huge announcement when it came down, and that was that Trump had selected Kevin Warsh as the nominee for the Federal Reserve to replace Chair Jerome Powell. Well, the idea around Warsh was that he was an inflation hawk. This is how he's been viewed. This is how he's kind of positioned himself over the years. Also that, that he was eager to raise interest rates, and so overall, the idea of gold having this, the Fed independence being challenged, Warsh seemed like a safe pick. It seemed like he was very, out of all the guys that you could have picked, this guy seemed to have perhaps the most spine. However, if you just scratch the surface a little deeper, you'll find that Mr. Warsh has really flipped the script over the last year. So as he's gotten closer to Trump's orbit, even more close to Trump's orbit, he's definitely toned down the hawkish language. And I suspect that we'll get at least, 3 rate cuts out of Mr. Warsh. 3 rate cuts this year. Let me put it that way. Whether he'll be delivering all of them or whether Powell will do 1 and he does 2, who knows? But I suspect about 3 rate cuts. And so I think it was overdone on gold. I think there was a premium driving up gold due to the fear of the loss of the independence of the Fed. Warsh seemed to put a Band-Aid on that fear. And so therefore that premium was knocked out of the price of gold. But there's always something else to worry about, as the markets so well know. And so I suspect that we'll find another premium to price into gold. And so that's why I don't think gold is, going down the way that some might think it does. It's still, if you look at this monthly chart, it's still just going up and to the right. So yeah, that's a long upper wick on the monthly chart there, but I don't think it's the end. I'll just put it that way.
All right. I see your point and agreed. So what else we got here?
We can look also, you had mentioned silver. Let me come down to the silver charts. They're sort of down here a little bit. Silver obviously got more of the wind knocked out of it. One of the key moving averages that I've watched on silver for years, in addition to the 200 and the 50, is the 30 SMA. This just tends to be an area where silver is very sensitive. It'll tend to pivot, be a key pivot point. You'll see how it kind of held up at that 30 SMA right there back in October, November. It got tangled up at back, last summer. But we really slice below it in a meaningful way in late December or late January. I'm sorry. And you can see that the damage up there, we went from 120 down to 64, I want to say.
Yeah.
That's like a
intraday, yeah.
Yeah, it was nuts. Just incredible decline so quickly. But again, Kerry, you probably can speak to this as well. You could see it coming. I mean, it was clear. I mean, I often tell my students, think about how you feel whenever you're in one of these moments. I can think back many times of different assets that I would be holding, and I would see them going up, and then they would start getting irrational as they were going up, and you begin to feel something. And I often tell my students, really pay attention to those things that you begin to feel, because once you start to feel that, once you start to see it, I'm talking about people who have experience, not just people who, they don't know anything about it, but when you have some experience, you've been doing this for a while, when you start to feel it and it's really starting to get pretty wild, that's usually a big sign. Every time I've felt that going back through the years, it's usually been 1 or 2 weeks,
Always,
right before the end, and it's usually right around the time when big major outlets like the Wall Street Journal are like, it's time to buy silver, or it'll be, or there'll be, CNN will be like, it's time to buy gold. How do we buy gold? It's like already up at the, so usually you get all, the cab drivers giving you advice, and we've been here, and so you definitely felt that with silver on the way up, and it got pretty crazy there in January. So we knew we were due for a pullback. This one, I'm not as confident that it's going to get back to a new all-time high as quickly as gold, but I do think there's still plenty of upside for silver as well. The industrial demand, case in point.
Yeah. So silver is a lot different than it was in 2011 and in 1980 with the Hunt brothers, right? Mm-hmm. It's way, way different. We've got basically a structural shortage, increasing demand on the industrial side, and to some extent, increasing demand on the investment side. So, it became parabolic. So anytime you see a parabolic move, it doesn't matter what it's in, it's going to get slammed, whether it's Bitcoin, whatever. And we're just seeing it now. But the fundamental demand side of silver, not changing.
Yeah. I mean, not really. I mean, you've got really sustainable industrial demand going out for as far as we can see, barring just some sort of black swan event that takes down global demand, which could happen. We need to be prepared for that. That's why we want to be diversified. You don't put all your money into gold. You don't put all your money into you don't put all the money into Bitcoin. You spread it out. You got to spread out the wealth. You never know what kind of evil will come upon the land, as the old quote says.
Yeah.
If you look at silver S&P ratio, for example, we're not anywhere near where we were back in, say, 2011. We're still way below it. But, for a while there, I think people were starting to give up on silver, right? I mean, silver had just gone so long where, you're just looking, saying, is this thing going to do anything? And sure enough, it came back and played its role in an incredible way. I think that's the other important thing to keep in mind about the metals, too, is that, even though you have that core position that I hold physical gold, physical silver, I call it portfolio insurance. I usually keep, 10%, 10 to maybe 15% at most in, hard assets like that. Barring, and I consider real estate to be a hard asset as well, but I consider that another bucket. So, I have some money in real estate. I got some money in stocks. I got some money in hard assets. I got some money in crypto. I got some money in my own businesses and invest in other people's business. So you just got to spread it out. Exactly. And I think that the danger is for those who just go all in. They watch a video online or they read an article and they say, this is a can't lose investment, and then they just put all of it in, all the chips in. And then when that blows up, they think, well, investing doesn't work. I guess I'm not going to invest anymore. Well, that's not how it works. We need to be spread out. So for everybody listening, I think that's one of the best things you can do. It's some of the oldest advice out there, but it really is true. You really want to be spread out, even if you think that the United States government, is bankrupt, like I do. Even if you think that there's no way out for the United States government, there's still always these unknowns that you just can't account for.
Like AI.
Perfect example, right? And that was really, AI was a huge part of the silver rally because of all the expectations, the silver going into data centers. It already had this huge demand from solar, which is growing, by the way, in every other country except the United States. Actually, the United States is actually doing pretty well. I've been surprised to see many renewable energy stocks actually thriving over the last couple of years, which is kind of interesting. But yeah, definitely we're still seeing the build out of renewable energy all over the world, and that's huge for silver. If we turn to, say, the S&P or just looking at the broader U.S. stock market, it's starting to get a little top heavy here, even though the rally is not too terribly old. I mean, if we go back and we see the rally, it really kind of kicks off in the wake of the 2022 crash. You had that terrible time in 2022 where everything was going down, it seemed like. And then as we entered 2023 and the rate hikes stopped, things like the S&P 500, started to go back up, and they've been really trending higher since the end of 2022, albeit with some pullbacks like the big, tariff tantrum that we had back at the beginning of 2025. But you can see since that time, we hit like 4,800 on the S&P back in April, and it's not even a year later, and we've already gone up to like 700. So, I mean, it's been really an incredible rally. And you can see we broke out above that 200-day moving average. What was that? That was like maybe 9 months ago or so, not even 9 months. So, it's not like it's that terribly of an uptrend here. Kind of got reset there. So I don't view the S&P 500 or the overall stock market as due for a, getting cut in half again. I think I see earnings power really big over the last couple of years. The S&P earnings have been just incredible, and that's what drives stock prices. We've also had some volatility in the tech space. We've seen software stocks get hit, kind of taken some valuations down. So overall, as we look to the end of the year, I'm bullish on the broader market indices, the NASDAQ 100, the S&P 500, and the weakness that we see. I mean, take a look here with the S&P. I mean, it's still trading above that gold line. That's the rising 200-day moving average. And so you break down. Yeah, and until you break down below that, I mean, you're doing pretty fine. If you break down below that, well, then, you might have some pain ahead. But overall, again, you're right. And for us, I mean, the way we approach this is we just DCA. So we'll dollar cost average into our favorite stocks, our favorite ETFs, our favorite digital assets, our favorite hard assets, and just take it all in stride, be patient, let patience have its work. And, so S&P 500 right now, for example, if you look at the internals, you'll see that about 67% of those stocks in the S&P 500 are above their 200-day moving average. That's bullish. So, market's still looking pretty darn good right now. And I don't suspect this administration is going to do anything but print its way out of problems. So I don't think that they're going to pay off. They're not paying off the national debt. They're not going to impose austerity. They're not going, they're at least upon the markets, they're going to, or upon investors. They're really just goosing the markets as much as they can. And I think we just hit Dow 50,000 the other day. Yeah. I saw Trump, made a real big deal about that. President Trump said, "Hey, look, Dow 50." I think that's code. You need to realize that, that's something that's very important to him. It's part of his legacy. He ties himself to that stock market more than most presidents. And so therefore he's going to consider it a personal insult if your stock portfolio starts to go down. He's going to worry about his legacy. So therefore, in some ways, you have a little bit of extra insulation for your stock portfolio from Mr. Trump because he does tie it so closely to his legacy.
Hey, what about volatility? We're looking at higher volatility, though, in the markets?
Well, sure. I mean, it has been threatening to pop up a little bit. I have a chart here we can just look at real quickly on volatility. Let me pull this one up here. So volatility sitting at about 20, 21 or so. You can see that really big spike in volatility that came back in the tariffs. Are we going to have some of these? Absolutely. To me, though, again, these volatility spikes, anytime you get above, say, 25 on volatility, to me, it's a great time for me, I'm not talking to everybody, but for me, it's a great time for me to double up my dollar cost averaging, or I go a little more because those moments don't last forever. And so the more scary it feels to me, the more, the more I try to take
blood in the streets.
Right. Absolutely. Absolutely.
Yeah.
And you have to learn it. You have to learn it the hard way. I mean, when I started investing, Kerry, I was very afraid. This is many years ago, probably 2 decades ago, whenever I really started getting heavily invested and trying to become more of an investor. And I would get shaken out of stuff so easy. I would, I'd see a headline and I'd scurry and sell. And, and so I've learned over time just to be more calloused and to be more, to be less reactive.
Yeah.
And to really take
advantage
of
age.
It does. It comes with age. I mean, and you've got to take a few blows. You've got to kind of see. And so now when that volatility gets high, whereas in the past, I would be nervous and scared. Today I'm like, hey, there's my opportunity. I've been waiting for this. This doesn't happen all the time.
Great point. All right. Interesting insights here into the markets. We appreciate the tour, Jerry.
Absolutely. Yeah.
So effectively, metals could be getting some resistance, but gold looks like the political economic situation is bullish. Silver took such a hit that it's going to take time to get back. It hit like a false breakout, 120, and then a false crash at 64. So somewhere in between those two numbers where we are kind of now, maybe between 75 to 95, probably where it's going to be hanging around, or 70, because the spread on it, the volatility has been so huge.
Mm-hmm. Well, and who can complain about that, huh? I mean, you and I talking about $75 or $95 silver. I mean, 5 years ago, we'd be tickled, to hear about that. So it's not a bad range to be in,
I started buying in the crash of 08, 09, and it went down, most of my
like
physical
6 or 7
hold.
bucks, or I forget what it got.
8 to 10. 8 to 10
bucks, yeah. I remember buying my very first silver piece. It was at a pawn shop, which I don't recommend you buy them at pawn shops, but but it was my very first silver piece, and it was like 2003 or 4, and it was $5. It was just a $5 silver round, and that was with the markup, And I thought, good night. How time has flown and how things have changed. It got to 120, and I saw it at 5. It's crazy.
And it always does the same thing, but this time again, there's just not a lot of silver above the ground. Actually, I'm putting together a special silver report called, living the silver-backed lifestyle. And the fact is, back in 70, let's go back to when silver was still money. In 64, you could buy a gallon of gas for 2 silver dimes, or maybe 25 cents. It did go down lower, actually, in the early 70s. I remember with my father buying gas at Pathmark in New Jersey at $19.9 and $22.9 for premium. But now 2 dimes buys you, I don't have the numbers in front of me, but basically buys you like 3 or 4 gallons. So the real purchasing power of silver, even though it's been suppressed and everything else and volatile, has done nothing but go higher. If you look at how many ounces of silver it would take to buy a house in 1960, it was like 11 or 12,000. Now the average house, $500,000, just call it 70. It's basically 7,000 ounces, or 700 ounces rather, 700, 7,000. So cost in silver has actually gone down, which means the real purchasing power has gone up, and the gold to silver ratio, everything else is kind of wonky. All of that's going to be in my report. So just shoot me an email. It'll be on my Substack for paid subscribers. You get an early view of it, and a lot of insights in there.
Kerry, right along those lines, if we have one more minute, let me just show one more chart.
Oh, I love it.
That relates to that. Not only have we lost that purchasing power, which in so many ways is immoral, the fact that we have lost so much, and for no purpose other than the fact that the government just didn't want to, keep itself within the constraints of normal spending. It wanted to, monetize debt, and it wanted just to go on and on. So we've ended up with this destruction of our monetary value, which hurts everybody, kids, women, men, workers, and students, everybody gets hit. But take a look at this chart from the Economic Policy Institute, which I find so interesting. And we've seen this reiterated so many times over the last couple of years. There was a Wall Street Journal report that came out that's newer than this that shows even more stark numbers. But this just shows what happened to the growth and productivity, i.e., output, versus compensation. And you'll notice that productivity in the country and compensation were growing at basically the same rate, all the way up until the early 1970s. And it was at that time, whenever the dollar got split from gold and from
71.
Got untethered, August 15th, he interrupted that bonanza show, Nixon did, and told us about it. But then we see here that they begin to separate. And so you begin to see the compensation is not growing anymore. So your hourly rate, your wages are not growing, but the productivity is going up. So in other words, the closer that you are to that printing press, the more money you're making, and the further you are from that printing press, the less you're benefiting. So investors are the only way for the little guy to get ahead in this kind of funky economy where it's quite frankly immoral, is that you have to own assets. You simply have to own assets because they will go up with the money printer, whereas your wages won't. And people know that, but this is a graphic, graphic proof that shows that it was right at that same time, that 1971 time period, where we saw a lot of things break down, not just our monetary value,
Yeah, and average Joe Sixpacks knows it from the value of his house going up.
Yes, absolutely.
So true. So true. Well, where do we find you these days, Jerry? Where's the best place?
Kerry, thank you for having me on. Followthemoney.com. Whether people are looking to become better investors, learning how to trade, we have trading software. We do ongoing webcasts for our members. We have a trading software. We've got all kinds of stuff here. And lots of free stuff, podcasts and articles and things like that. Followthemoney.com.
All right. We appreciate that and appreciate you coming on. As always, Jerry, questions, comments, shoot me an email, kl@kerrylutz.com. We answer all questions. And my site, financialsurvivalnetwork.com, but I totally switched to Substack because it's just so much easier managing the whole thing myself, much less outside help needed, and just a very powerful platform. So join 55,000 others that are on our Substack. And Jerry, we'll talk to you again real soon.
Thank you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.